Welcome back to the third video of the option series. In this lesson, we're going to talk about definitions, and for some definitions, we're going to give a couple examples. Um, some of the terms especially the first three, are repetitive. We already talked about them, but they kind of build on what we're going to talk about in the next, like the harder definitions. So it's kind of good to get a grasp and like remember what these terms are. And I also want to introduce new terms that would kind of give you a good understanding that will help you go into the future videos that will kind of be a little challenging. So knowing these terms now, it will help you. So first things first, we're going to talk about strike price and expiration. So I hope you remember this, but the strike price is the price at which the option contract allows you to buy or sell the underlying asset. And so for a call, it's the price you can buy the asset, and well, for a put, well, obviously it's the price you can sell it. And so strike prices are preset levels, they don't move, and they're chosen when you open the trade. And so whether an option ends up profitable or not, it depends heavily on the relationship between the strike price and the market price of the underlying asset. And so this is where the concept of moneyness comes in, which we're going to talk about. And yeah. So in short, a call is more valuable when the market is above the strike price, and a put is more valuable when the market is below the strike price, right? Because you got to make that profit. The second key term in this slide is the expiration date. This is the deadline for your options contract. It's the point at which it has, which either has value or becomes worthless. And so, unlike stocks, which you can hold forever, options are very time sensitive. They have an expiration that could be anywhere from a single day, which is known as 0 DTE, 0 days to expiration, all the way to multiple months or even years in the case of leaps. And so the closer you get to expiration, the faster your option begins to kind of like lose value from time decay, especially if it's out of the money, which we're also going to explain what that means. And so there's like kind of like this ticking clock, which is what separates options from most other assets. And it's like this why timing matters just as much as directions and option trading concept comes in. And so, kind of in short, the strike price defines your trade level, and the expiration date defines your time limit. And so, like, kind of together, when you combine them, well, they shape the structure of every options trade you'll ever make. Next is we have the option premium. And so, this is which the price of the contract itself, right? Yeah, the price you pay for the options contract. And so when you enter an options trade, you're not just choosing your strike price and expiration date, you're also dealing with a cost. And that cost, well, is called the premium. And so this premium is the amount paid by the buyer of the option. So if I'm buying an option, well, I got to pay for it and I'm paying the premium. And the seller, well, he collects the premium. And it's a one-time payment, and it happens upfront at the moment the trade is open. So you can think about it, if you go to a store and you buy an item, it's the same thing. You buy the item, that's the premium. And if it goes up in value and you want to sell it for more, well, that's kind of what it is. It's kind of like reselling. You buy it and then you kind of hope it goes up in value. I guess reselling is more of a call option. But anyways, it's a stupid example. I'll give you a better example. Let's say you buy a call option with a $100 strike price, right? And let's say it expires in 30 days. And the premium is $4 per share. And so, since most contracts represent 100 shares, that $4 premium really means $400 in total cost. And so, this money is paid immediately and is non refundable, even if you never exercise the contract. On the other hand, if you're the seller, it's the opposite. You collect that $400 as income, but in exchange, you're taking on the obligation to fulfill the contract if the buyer expires. A common beginner mistake is assuming that the premium is based only on how close the strike price is to the current market price. That's only part of it. The premium is actually influenced by several factors. These factors could be how far in or out of the money the option is, how much time is left before expiration, the volatility of the underlying assets, and market demand, which is based on open interest and volume, which everything will be talked about in this video. And so these factors combine to determine what the market is willing to pay for that option, and premiums can be cheap or expensive depending on conditions, and understanding why is what separates experienced traders from beginners. You could kind of think of premium as like the price tag of your optionality, and it kind of reflects both the potential and the probability of the trade working in your favor. In future lessons, we'll explore what premiums rise and fall and how to evaluate whether they're fair, overpriced, or a bargain. But yeah. So here, kind of building on option premium, one of the most important things to understand is about an option's price, especially when looking at a premium. And so the difference between intrinsic and extrinsic value, well, that is the option premium. Sorry. Let's start with the intrinsic value. This is the real built-in value of the option and is based purely on how far it is in the money. So for a call, intrinsic value is the amount the stock price is above the strike. So for a put, it's how far the stock is below the strike. It's the opposite, right? So if the stock's trading at 110 and you hold a call with a 100 strike, well, the option has a $10 of intrinsic value. If the stock is only at $90, that same option has a 0 intrinsic value and it's like out of the money. And so this part of the value is guaranteed, and if the options were exercised immediately, that's how much money it would be worth. And so the second term is called the extrinsic value, and this is like the extra part of the money, and it comes from time, market expectations, volatility, and it reflects the idea that even if the option isn't in the money yet, it could still get there before expiration. And so that possibility is worth something, and that something, like in quotation, that something is the extrinsic value. Also, extrinsic value does decay over time as expiration gets closer, and that value shrinks. And this is why options lose value day by day, which is a concept called theta decay. We're going to talk about it later. And so even if a stock doesn't move at all, an option can lose value simply because it's running out of time, and that's the effect of extrinsic value fading. You may wonder, well, why does this matter? Well, understanding the split between intrinsic and extrinsic value helps you know what part of the premium is real versus speculative. You can kind of decide whether to exercise, hold, or close a position, and you avoid overpaying for hype-driven contracts. Okay, so next, what we're going to talk about is something called open interest and volume, and these two kind of get mixed around. So let's start with volume. So volume tells you how many option contracts have traded today for a specific strike and expiration. It resets to 0 each morning and builds up over the trading day. A contract with high volume means a lot of activity, which means buyers and sellers are both present, and the market is something called liquid. That usually results in tighter bid-ask spreads and better fill prices. Well, there's something else. On the other hand, well, there's low volume. Now, it's not necessarily a red flag, but something you should watch out for. It means fewer participants, wider spreads, and a potentially slower or worse execution. And even if the premium looks good, well, that trade might be hard to get in or out of because of low volume. Now, on the other hand, for open interest, it is confused with volume, but they're very, very different. Open interest shows you how many contracts are currently active and have not been closed or exercised. So in other words, it's kind of like how many people are holding a position at this strike and expiration. It's cumulative, unlike volume, and it doesn't reset each day. And so if you see 8,000 contracts of open interest, that means 8,000 contracts are live in the market and someone is holding the other side of each one. Also, high open interest is a sign of strong market participation, and it gives you confidence that there's enough liquidity to trade in and out when needed. Well, why does this matter? Well, both volume and open interest give you insight into liquidity and tradability. You could have a great idea and a perfect setup, but if nobody's trading that strike, you might get stuck with a contract you can't exit, or worse, get filled at a worse price. And so when you're scanning an option chain, which we're going to talk about, always check, is there strong volume today? Is there enough open interest at that level? And high values are both green lights. Low levels proceed with caution. Sorry, low values, you should proceed with caution. So this term, moneyness, it's a very, very weird term, but it's quite important. And it's also one of the most important concepts in option trading, especially when it comes to choosing the right strike price. So moneyness kind of describes this relationship between the option's strike price and the current market price of the underlying asset. It tells you whether an option is in the money, at the money, or out of the money. And this matters a lot. So in the money, which also has an acronym of ITM, an option is in the money if it has intrinsic value. So for a call option, that means the market price is above the strike price, so that holder has the right to buy at a discount. For a put option, it means the market is below the strike price, giving the right to sell at a higher price than the current market. It is in the money. You're making money. In the money in the money options are more expensive because they already have value built in them. And they also generally have like a higher probability of expiring with value, but you pay for the edge through a larger premium. Next is at the money, so ATM. Not ATM like a ATM machine, but ATM at the money. And so it's an option that is at the money when the strike price is very close to or equal to the current market price. These options are often most liquid and they're commonly used by day traders and scalpers. And so they have like a zero intrinsic value but high extrinsic value because there's an even chance they could go either way before expiration. They're also popular for short-term directional plays because they react really, really quickly to a movement to a movement that is like underlying. Last but not least, we have out of the money OTM. It is an option that is out of the money when it has no intrinsic value at all. So a call is OTM if the strike is above market price, and a put is OTM if the strike is below market price. And so these options are the cheapest, but also the riskiest because you're kind of hoping that it would either go up a lot, the price, or down a lot to get into the money. And they require the market to move significantly like in your favor before expiration. And if it doesn't, well, they expire worthless, right? You're kind of like, yeah, you're getting it for cheaper, but you're also hoping that it would kind of get this push up and go into the money, or I guess push down if you're getting a put. And so that said, OTM options kind of offer high reward potential with lower costs and are often used for speculative trades. Well, why does this matter? Well, moneyness affects your premium cost, your sensitivity to price moves, which is delta, and a probability to profit. And so even strategy design, spreads and hedging. Last but not least, let's finish this off by kind of tying all these terms together into the tool you use every time when you trade, which is called the options trade. It's kind of this big thing. Sometimes they're smaller, sometimes they're bigger. And so an option chain is a table usually built into your broker's platform that lists every available options contract for a given stock or ETF. And it shows all the strike prices, every expiration date, current premium, so both bid and ask, a volume and open interest, moneyness, whether your option is in, at, or out of the money. And so on most platforms, you'll see calls on the left, as you can see right here, and puts on the right, with the strike price in the center. Each row represents one strike, and so that data for each expiration is organized clearly so you can kind of see quickly. The reason this option chain matter is because this is where traders filter and analyze which contracts are worth trading based on everything we've just learned. You might look for high open interest or kind of like target options that are ATM or slightly OTM. You might be looking for you might be avoiding contracts with low volume or wide bid-ask spreads. And so you could kind of like sort by expiration, volatility, or probability of profit depending on your trading platform. Another thing I want to mention is delta. Well, what is delta? Well, delta measures how much an option price will change for a $1 move in the underlying asset. Its numbers between 0 and 1, as you can see, for calls, and it's between 0 and -1 for puts, right? Because they're opposite. So you could think of it as like a sensitivity gauge for options prices. So for instance, for call options, a delta of 0.5 means that the call will gain about 50 cents for every dollar increase in the stock price. And so the deeper in the money the call is, the higher the delta, often between, let's say, 0.8 to 1. Out of the money calls might have a delta of 0.1 or lower. And so for put options, a delta of -0.5 means the put will gain about, let's say, 50 cents if the stock drops to $1. And that negative sign just shows it moves in the opposite stock price, like I mentioned. And deep in the money puts have delta closer to -1. We may wonder, well, why does that matter? Well, delta matters in the chain, and it helps you estimate how your options will react to price moves. It's also useful for picking options with the right balance of cost and responsiveness. And at the money options usually have delta near plus minus 0.5, depends if it's a call or put. And it could be used to estimate probability of expiring the money. So delta of 0.3, which means a 30% of integration. So yeah, I hope this video helped kind of see these definitions. I really suggest writing these down and kind of taking notes of these, because these definitions are going to be used a lot in the future lessons that are coming up, that are going to start getting harder and harder and more conceptual. So yeah, I hope you enjoyed this video, and I'll see you guys in the next one. Thank you.